Welcome to the EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Retta. Today, we continue with our EIS Basics series, and we're talking about how to choose between EIS and VCTs. As a reminder, as well as the audio version, you can see a video version on YouTube. And we also need to add a disclaimer this one about, because we're actually straight into the area of advice, anything you hear is for general information, and if you want to talk about your particular circumstances, we suggest you speak to a financial advisor. Today, I'm joined by Francesca Rayneau from Calculus Capital. Welcome to the podcast.
Thank you for having me on, Brian. We've known each other many years, so it's nice to finally be on the EIS Navigator.
Yes, it's great to have you. We had your boss on way back in episode 92. If anyone missed that, maybe you want to tell us a bit about Calculus.
Yeah, of course. And actually, funny story about that podcast, I made a very good business relationship from that podcast. Somebody listened to John Glencross, who's the CEO of Calculus, on episode 92, called in and asked to speak to me because I'm the head of investor relations and we still work together to this day. So, really good business relationship forged via this podcast, Brian. So that's brilliant. So Calculus, we are an EIS and a VCT manager. We have been going for over 25 years. So John, who Brian mentioned, is a chief executive. He set up Calculus with Susan McDonald, who's still the chairman, back in 1999. So what they were doing in the 90s were they were essentially making single company EIS investments. They were doing it for themselves, also for friends and family and other business relationships. And they decided that actually it would be good to structure that into a portfolio structure and manage a fund. So they applied to, it was the Inland Revenue at the time, and they actually launched the UK's first approved EIS fund. And Calculus has gone on to launch an EIS fund every year since 99. So we're on our EIS fund 26. We have the Calculus VCT, which launched in the 16-17 tax year as well. And we also have another arm to the business where we finance UK TV and film productions as well. So we have a media finance arm. But yeah, predominantly tax efficient investment managers.
Yes, excellent. And as you mentioned, you manage both VCTs and EIS, so you're really well placed to discuss how people think about, choosing this. So I think in some sense we're thinking about a hypothetical situation. Someone has decided they want to invest in venture capital. They have the choice. How should they start thinking about it?
Yeah, and I liked your disclaimer at the start, because I was going to say the same thing, just to caveat, I'm not a financial advisor. I'm obviously talking broadly about the fits and the tax release between the products. Mm-hmm. But as you mentioned, people should talk to a financial planner. I think it's, we bracket these both together because they were launched in the mid-90s with the same aim. Mm-hmm. And that aim was to drive private investment into these small, innovative, growing UK businesses, which stimulate, the economy via employment and innovation. And that was the government's, target for EIS and VCT. Now, they were structured in a different way, though. So the tax wrapper is slightly different. So obviously, as an investor in a VCT, you're buying shares in the trust and you hold shares in the VCT, which is a listed vehicle listed on London Stock Exchange. And you'll get access to a portfolio of, it depends on the manager. For the Calculus VCT, we have a portfolio of 40 companies. Some managers are a lot larger, some smaller, depending on, how long the VCT has been on the market. And you have access to that portfolio via the shares in the VCT. Now, as an EIS provider as well, if you invest into the EIS, you will take the shares into each underlying investment. So you'll be directly a shareholder of the company, and you will receive a portfolio which is, much lower in terms of investment amounts than for the VCT. So, it could be something like a portfolio of 6, 8, 10 different companies. So I think, that's the differences in the structure. And I suppose that will lead me on to, the original question was, where do you start? So I think it's good to think about, what's your interest? What's your risk appetite? Mm-hmm. If your interest really is in these underlying investments, you have they're both risky products by nature. They're investing in UK small cap, but obviously with the VCT, you get access to this larger portfolio, more likely a lot more diversified. And so therefore it's kind of more of an entry level product, some might say, into UK VC. And with the EIS, what you have people that have already invested in EIS via some sort of friends or family round, or have an interest into the investment strategy, and therefore have, real interest in the portfolio companies, and are willing to take a bit more of a risk, because as mentioned, you will feel those losses more so with the VCT, which is a wider, more diversified portfolio. That question is very multifaceted, and I could go on for a long time about it. But just to say, as a broad point, think about your appetite for risk, your diversification, and then, of course, and what we'll come on to is, the tax release that you want them for, because there's a different suite of tax release depending on the product.
Mm-hmm. Yeah. I like your comment about VCs as being an entry, good entry, because I think different investor profiles have different needs here. And if someone's new to investing in sort of the venture capital sort of small end, then VCTs may be a good entry point. If you already have a portfolio, then EIS can let you tailor it. What other sort of investor profiles do you think of when you're talking to people?
Yeah, I mean, again, it comes back to the tax release as well. So obviously people will normally sit down with their financial planner or tax advisor and think about, what they want to invest in depending on their tax situation. And also, and the thing I should have mentioned as well at the start is a liquidity point. So with an EIS, as you being the underlying beneficial shareholder of each company, you then have to wait for a manager such as Calculus to exit those companies before you get the return. And that can be, you have to hold for minimum 3 years for EIS. But in reality, it's likely to be much, much longer than that. What we're trying to do as a fund manager is take these companies, grow, scale them, and then obviously find a willing buyer at the end of, what we believe is our holding period. So, in reality, it could be, 7-8 years before you're having the exit point for each individual company. With a VCT, you have to hold for 5 years, and you most likely can sell the shares back via a buyback with the manager. So it's just knowing that you can get out after the 5 years with the VCT is quite attractive to some people. But I think difference in an investor profile, what we're seeing is, taxes are only going one way. People are more interested in both of these products. We're seeing a slightly younger kind of demographic, certainly with the VCT, because as well with the VCT, you get the tax-free dividends. So people that really want the dividend stream, want the income generation from a VCT. So we did used to see it was people that were either retirees or trying to plan for their retirement, very close to retirement age of the VCT, because they're thinking, if I invest in multiple VCTs, I can get this income stream throughout my retirement. But actually, that level's got a lot lower in terms of age, because people are trying to find new ways to invest tax efficiently. Pensions won't be as attractive from 2027 as a legacy planning point as well. So people are really looking to EISs and VCTs. I think as well with EISs, what we see, so I spoke about VCTs, investor profile. With EISs, what you see is the kind of entrepreneurial sorts that are really interested in EIS investing. As mentioned at the start, have a higher risk return profile as well, and a real interest in the sectors that the fund manager that they're investing into, invest in with their investment strategies. For Calculus, and this isn't supposed to be a pitch for the fund that I work for, but we invest across tech, healthcare, and entertainment. So that's a diversified approach, and some investors really like that style. They're getting access to 3 key sectors. Some have a real interest in technology or early stage healthcare, and they look to the fund managers that do that, and it aligns with their interests.
Yeah, and I think it's worth mentioning, other managers. That I think EIS, broadly speaking, has a wider range of specialities. So if you were interested in climate tech, or or specifically wanted pharma only or whatever, you can find that in EIS. There are some things that are only available with VCTs, pretty much. I mean, AIM, there's a set of AIM VCTs, and getting AIM EIS. I think there's one option in the market. So you have a wider choice of VCTs and some of the other VCT strategies. which generally tend to be slightly later stage. I mean, I know you co-invest alongside, but I think other VCTs invest at a later stage than a lot of EIS.
Yeah. So I think, so to talking about what I know is you're right, we have a co-investment. So essentially when we make an investment into, let's say, a healthcare company, we'll decide what portion will go to the EIS and what portion will go into the VCT. I think historically, and maybe some managers now still take their EIS and do the early stage stuff into their EIS. You have EIS managers that do lots of university spin outs or really early stage tech. And then with the VCT, you have that they will put the kind of slightly later stage, but obviously they also have to qualify. So these are still early stage businesses, but they'll put their slightly later stage into a VCT again. And it's back to the risk return profile, isn't it? With an EIS, you could get one, 15 times, 20 times return, but the rest fail. And it all evens out at, X multiple that's a lot lower than 15 times. But with the VCT, because managers are, what they want to do is be able to pay that dividend year on year, and they don't want, a really high failure rate. So therefore, we're looking at a different risk return profile, and we'll do slightly later stage investments into the VCT.
Yeah. And I think that's generally correct. So you mentioned about sort of tax, and while we've covered the tax reliefs in detail on previous episodes for both VCTs and EIS, and if anyone wants to know more about those, you can go back and listen or watch those. But do you want to sort of how that affects sort of people thinking about this from a planning perspective?
Yeah, for sure. I mean, the greatest suite of tax reliefs with the EIS. So people that have just had, a CGT liability, for instance, you're not going to get any relief with the VCT. VCT is income tax relief only, tax-free capital gains. Any gains are free from CGT as well. But that, it's an income tax play, and you can only claim the income tax relief in the year you make the investment. For EIS, you have so many more different types of tax relief. So I think, and going back to the investor profile point, a lot of our EIS investors have had a CGT gain. They've sold second property or shares, and they have a big liability, and they want to find a way to defer that liability because you can't fully erase it. You defer it until a time that it's most applicable to you. So it's good for cash flow planning. Or also the tax legislation might change, and you could be deferring it to then get a more favourable CGT rate. But really, it defers until you could die with it, and then it will be fully erased. But we see that's quite a common thing is people with a CGT gain. Also for IHT planning, because after 2 years they qualify for business relief with an EIS. So any shares that you hold in EIS will sit outside of the estate. That's recently been changed in 2026 to capped at £1 million for private and business relief shares. So after the £1 million cap, you'll then be taxed at a 50% rate, which is basically 20%. It's 40% is the IHT rate. Yeah, lots of complexities about IHT and all of the different caps. But yeah, basically, if you go over £1 million worth of BR shares, then you'll get half relief. So that's another classic use case of these types of products. And then you have downside protection with the EIS. If the companies were to fail, you benefit from loss relief as well. So yeah, it's funny with advisors is you'll find they have different camps. People really favour VCT, people really favour an EIS, and then of course advisors do both. And I think, and this is a very diplomatic answer, and of course I would say this, wouldn't I? Because I work for a manager that has both products. But really, a nice combination of the two is also extremely beneficial, depending on the client's circumstances.
Yeah, and I think you can easily construct circumstances where. So sometimes I suggested advisors a good strategy for new people is you invest in your VCTs to get like a basic exposure. Then you add EIS, which really because I think all other things being equal, the cash drag in VCTs gives you a little bit of a return reduction. So EIS then is the sort of second stage of investing where you get. You can do stuff that's maybe a bit more interesting, or you get perhaps a closer relationship with the companies, depending on who the manager is.
Exactly that. Yeah, you're definitely a lot more close to the portfolio companies with an EIS. And, just talking with my investor relations hat on is I'll know my EIS clients more than my VCT clients. It's, almost quite sometimes standoffish approach. They'll get their accounts once a year. They'll read them with interest. Administratively, it's easier as well because you get one tax certificate with the VCT and you can claim it, straight away. With the EIS, it's, a lot of, hand holding it in, and that's in a positive way, not a negative way. It's, all of the contract notes and the EIS 3s and people really wanting to learn about the portfolios. And, we run portfolio events and people can come speak to the company CEOs. And so it's just a completely different type of interaction. VCT investors, we'll have people that do the full maximum every year, 200,000, not necessarily with calculus, but, we'll do one VCT a year that pays their dividend at different points as well. So they're getting essentially an income for every single month of the year. And they'll hold so many of these VCTs to the point where they probably don't even know who they have anymore. And within EIS, it's different. They will really closely look at what goes on beneath the bonnet of the portfolio. And again, like I say, feel the losses more heavily, but also feel the rewards a lot more heavily as well. You have that big return, and that's going to really, affect you in a great way.
Yeah, sometimes with the VCTs, I have this, I sometimes call it the veil of ignorance, which is not a derogatory thing, but people see the VCT, but don't necessarily look that second layer down. So this is into the companies and the way that they do in EIS, I think. So yeah, I think.
Yeah, as long as it's paying its dividend and, they look at the accounts and see that the performance of the companies beneath it seem to be, doing well. And of course, you're always going to have a variation. That's the nature of this early stage investing. Of course, you're going to have some that fail because otherwise we're not doing our job if we don't have failures. To put it bluntly, I think the HMRC would take a closer look at it if nobody had any failures. And there's just so many portfolio companies to keep a track on with the VCT. We're a small VCT, and like I say, we're close to 40, whereas some managers will have over 100.
Yeah. But concentration means sometimes it's not quite as diversified as 100 sometimes think.
Yeah.
But
some managers cap that. We cap our largest holding. Our largest holding is less than 6%. Mm-hmm. Some people have holdings that are much larger than that. But because we're a smaller VCT, we cap it for that very reason, just from a diversification point.
Mm-hmm. Yeah. But as you say, we could discuss this for a long time about digging into all these sort of extra details. Are there any other factors that you would like to sort of mention at the moment?
Yeah, I think an important thing to look at, and I have this, conversation with a lot of people, is the fees. This is always a topic which can be quite polarizing because these products do take a lot of management. We're obviously investing in these small businesses, but also trying to grow them as well. And one of our investment directors will take a seat on the board, and that doesn't mean just rocking up to 4 board meetings a year and that's it. That this really means kind of becoming almost like an extra employee. And they'll quite often sit on more than 5 boards, as in different company boards. The fees, it commands a higher level of fees than other products. And again, this is a thing that advisors want to get into the weeds of. Where does it go? What are the management fees for? One thing I will say, and if I was trying to say to an advisor, look at who to choose for a VCT, I would look at the kind of how they structure their fees, and the performance fee especially. We restructured ours so that we only pay out on realised gains, because what you don't want with a VCT is managers paying themselves on paper valuation that hasn't come to fruition yet. So it's looking at the way that they reward themselves with a performance fee. Do they do it when they've had positive outcome in that year in terms of realised gains? Because that's what I would want to see as an investor. But having said that, both these products do take a high level of management and will command fees. But you still want to really look at how they structure those fees across the products.
Yeah, and I think something I said to several people in the past is there's limited economies of scale. If you're running an equity fund and people give you twice as much money, you can double every holding in an equity fund. In a VCT, you have to double the number of holdings.
Yeah, exactly. Exactly that.
So yeah, so the fees are going to, so you can justify sort of the higher fees as well a little bit.
Yeah.
If anyone wants to find out more about calculus, where should they go?
So calculuscapital.com, it's a good place to start, and our LinkedIn page as well. I like to post, updates on the portfolio. We've got a really interesting portfolio, and this is the bit that most people like to hear about, not just with us, obviously with any manager, is, who are they investing in? What are these companies doing? How are they going to change the world? Listening to those stories is the best way to understand, if you like, a manager's strategy. So I think, go on the website, go on Calculus Capital, have a look at our portfolio and our team, and give me a call.
Great. Well, thank you very much for coming on today, Fran. Really enjoyed chatting with you.
Same, likewise. It's been great, and hopefully we'll do something in the future.
Yeah, certainly hope so. So for listeners, as usual, you can get full show notes with links at harmonandco.com/podcast. You can subscribe to the podcast on all the podcast services and players, or through the link in the show notes. And for this series, you can also get it on YouTube. If you like what you hear, then please tell a friend or a colleague. Give us a review on your favorite podcast app. We can be contacted at inquiries@harmonandco.com. Thanks for listening and watching, and we'll be back in a week's time with another episode of EIS Basics. Thank you very much.